It's a market sniper, and we're talking about silver and gold. So for quite an extended period, we've been observing the price behavior, particularly of silver, but of course it's God market, the gold, we'll have a look at as well. This is an 8 hour, but I want to just show you what we do, because it's very important that people learn to stalk trades and learn to go and get into an environment where they are most comfortable. In other words, we specialize at looking at a certain structure, and we just look at these things all the time. It's a bit like somebody who can go to England and tell within seconds what part of United Kingdom from an accent that person has come. It's not something you're going to learn from South Africa or Panama. You have to keep going to different districts and talking to people in different parts of the United Kingdom so that you can actually pick up the different dialects. What you become by virtue of doing that, either inadvertently or even better if you have intent, it's a bit difficult to monetize calling regional accents in the United Kingdom. However, what we've elected to do is to look at volatility constriction events that are occurring in price behavior markets, and we will trade those. We do not trade by silo. Oh, we only do FX. Oh, we only trade the pound US dollar. I'm a specialist in that. No, half the time those markets may not be doing anything worthwhile where there is a real probability of an expansive reward for a very tight risk. In other words, it may not be right for trading. So we go where the circumstances are right, and we continue to look and take snapshots of things, especially when we get them wrong. And believe you me, we get them wrong. And when they go wrong, they're going to be 180 degrees wrong. But the key thing with stop losses is you don't lose any more than if you are just a little bit wrong. You lose the same amount of money, in particular with stop losses. So what am I going to be showing you? So we're showing you the silver market that we think is going to sell off quite hard. In fact, we were speaking about this a lot earlier if you were following my Twitter feed, and more importantly, if you're in our premium community, you would have known that we were stalking this for an extended period. In short, it's our view that there will be a deflationary sell-off in assets like silver and gold, and possibly in others such as Bitcoin and crypto. The crypto kiddies do not understand that the nature of the macroeconomics of markets is if we are seeing overshoots in inflation that are scaring people, the expectation will be rate rises. That will see tech stocks sell off again for more and further. Inflation is stubborn. A new generation needs to learn that lesson. I grew up in the Volcker generation, and I know what it took to kill inflation. Once it's got bigger than a certain size, it's a monster that's real difficult to kill. So our overall opinion is that the inflation number that came out, that was at 0.6, when you times it by 12, it's about 7.2%, is runaway. And that's not an acceptable level of inflation at all, especially when you're supposed to be targeting 2% and you're delivering 7.2. Oh dearie me. Guess what? They'll spin it as it's you folk that got given stimulus that has caused all this inflation, buying petrol, oil, goods, items, and it will never be your central banking cartel that has printed up 7 trillion and given it to the Kennedy Association and various other Democrat, Republican quangos and everything else that they want to hand pet projects stimulus money to. Anyway, before we go any further, let's just have a look at some of those scenario casts. So we were talking about stalking trades for an extended period. So let's have a wee peek at a couple of draws that we've done over the time with regards to silver. So here is the gold. We'll come back to gold a little later. Here is the silver market and our very first expectation. This is what we observed. We observed that there was a sell-off back down to the very heavy 22 level, that is over here, the blue line, $22 per ounce. You can see it, it's that line there, and that's the number that correlates to that line. You can see also that we then had this M head and then followed up with this structure. And our supposition is we came down not for the third time, but for a fourth time. 4 fingers, Francis. Yep, 4th time to the 22, and that points to heaviness. The other key elements that we were observing is that the momentum to the downside was very abrupt. This was a channel to the upside. So each rally after the 22, that's as high as you got up top there. That brought you your Wall Street bet silver. You then had your M, head and shoulder potential. You started to get very close to the 22, and then finally you made it down there. This rally was a lot smaller. This is indicating that we have this fatal magnetic attraction to the 22, and that for now it's been delta support, but there's been a lot of dip buying that's had to occur here, here, and then again here, and just before, it's worth mentioning, in there, and then again here. So our scenario cast was that you'd get a secondary high rally, a dip, and then a third high, and then you would set up for a sell-off. That would see you potentially make 13, but certainly 18. Now the 13, around about 13.38, is part of the head and shoulder sell-off. This will be a very intense deflationary sell-off, and is indeed possible. The 18 comes from this particular structure, which, as I say, if you learn how to do HVF method, you'll be common with. Now, it's quite common. We actually recognize inverted HVFs often form as right shoulders in complex head and shoulder structures because we continually observe this one unique event, and we keep showing up and observing it. And everyone else right now is very bullish, the precious metals markets, although after today, there might be the odd one or two that have started to flip in. We have been the only people we know that are bearish silver and gold, and actually first expect a sell-off, later the great inflation trade, the benefit for gold and silver. I'm going to leave, we'll come back to gold. Let's just knock on through with the silver. By the way, those were all dated, those charts. That first draw, pity I've already shut it down. The dates are in there. It was taken roughly the same time as the gold. So you can see this was 2021 in December that we were modeling for this. Here's the gold draw. We again don't like this structure and expect a sell-off. The 1800 to go above 1800 one more time, and then to come off, and then potentially trade into the 1500s to the downside. That was December. Now it's 22, and it was January, the beginning of January the 6th, and we'd already now had our second move up, and we're now selling off for the downside. So last time you saw us, we were here, and we just had that up leg and down to there. So actually the market price was there. You then had that subsequent secondary move, and we're getting that sell-off. This, as we've explained, is everybody's going to go squeezy, Japanesey up to the upside, and we are biasing to the bear side. Why? Because we recognize the difference between inverted HVFs and upside HVFs, and the probability is in our favor. I will also highlight to you that 94% of retail are long. Oh, dearie me. Long because of inflation. Wrong think, I'm afraid. Interest rates, if they're to go up, what that actually means is cost of borrowing is going to go up. There's a major problem on the debt markets. Go look at the Italian debt markets. Go look at the rates climbing on the Japanese, go the UK, the French, the German are even no longer negative and moving up very fast. The 10-year on the American is through the 2%, and we have an upside HVF for higher still. So what this points to is interest rates expectations on the debt markets are going up. Those debt valuations are plummeting, and it's extremely sensitive when you have a huge amount of debt and you're getting, even though in percent terms they're small, the actual move up in multiple terms is huge. And I've shown that sensitivity following the COVID split. Go check the bond market YouTube, where we were called out by the Society of Technical Analysts, and you will see what I mean by how the final capitulation was very, very large, and subsequently the rally in terms of log scale. Anyway, with that debt environment, what it's going to lead to is a deflation of assets. You're going to see tech stocks sell off particularly. You're going to probably see Bitcoin come down as well. They're going to be leaned on, and you're going to have this potential downside on the gold and silver anti-fiat markets. It's also likely to cause fear and see a bit of a run back into the dollar. Those are our overall views. You can see this was now the first And there's many other shots that I've taken. I don't want to show you every single snapshot we take of these markets. It would make the clip lengthy, and those are part of our records that we share in premium. But if you have a look now, if I go back up to the daily time frame and show you the structure now, and just wipe the face a little bit there so we can tidy up, you will see that we have now rallied, and we had waiting limit orders to be early on shorts, and I was filled around about there on the 23s level. It was around about the 23.5s on that wick, and we are now selling off down on the daily. So we've made 3 lows, and we believe that that will probably work out to be your 3rd high. If you have a look at that, for example, on a 2-dayer, and you'll see that that rejection is fairly brutal for a candle move. That would be known as a halfway mark of this candle, engulfing a rally, intraday reversal, and down. This is bearish. This is indeed bearish, and it's coming down with fairly high momentum as well. So our expectations are shorts have been entered. Our stops are at the top end of this wick. We don't feel there's going to be enough momentum to take you back up and run that. But if we are, we're out. We're wrong. Stop, run. If you're afraid, you can go for the top of the secondary high over here at 24.8. But we want to get size on. We want to be tight, and we're taking a bit of risk. The other thing that you'll see on here is the volume by price, and another key point that nobody watches, and we absolutely do. And you know, we wrong-footed all of Bitcoin at the 6,000 level in 2018, when we were again the only people short. Very similar structure, and I'll even pop past Bitcoin just to show you that structure so that people can recognize this. The volume by price weighted to the lower end size. Most of your trade here, your point of control line is around about here, just above the 22. The lean is on the floor, not on pushing up against the ceiling. You're looking for the trap door to the downside with this fear on rates and its effect on silver and gold. And as a result, be careful. Mind out below is our opinion. And so many bulls, so many bulls. It's got to be. Let's get things straight. I am a holder of precious metals. I believe it represents sound money. You're not talking to somebody who wants to see precious metals fail. Austrian School of Economics, etc., etc. Gold is a natural restrictor on callous governments that have overspent, over-indebted economies, etc., etc. But the fact of the matter is the market's going to do what it's going to do. Remember, this is also the paper market, and physical premiums, I expect, will expand as the paper price goes down, plus supply, great supply chain problems. Supply chains problems will probably also be quite prominent. Okay, so let's maybe just do that run by gold, because many of you will be on gold as well. And I will also remind you of that. Here we go. Have we got all of that? That was the silver. Let's let him go. That was from February, and we were waiting for the 3rd up and over. What do we got here? This is Wheaton Precious Metals. Oh, dearie me. Similar structure, Wheaton Precious Metals, jumping around a bit there, forgive me. Sell off. This points to, in our opinion, downside. Why do we think downside? Well, you'll learn about HVF method. We can be wrong, and if we're wrong, we're going to be 180 degrees wrong, and the 94% that are retail long will be right. It could be the case. We just don't think so. So we can see Wheaton running the 28 to the downside as well, and you could get short at around 40. With a stop at 42.66. So a couple of trade ideas there for you in this environment, and I'm happy and would look forward to the day that I'm going back long on those particular equities. Let's just show you that gold. We called gold in a similar fashion, and we feel that today you're hearing this video. We were in it, and I said to my guys yesterday, we're at the point that this needs to turn. This is in premium. I am saying it's put up or shut up time, and I am getting short. I actually had a limit at a level that had already been filled, and I added to that position and said, I'm jumping in front of the moving bus. We're trading to a level at a market that was coming up towards us. The shooting star, the sell-off is very validating. It means you get good early entries, and that's the cost you pay for not being in our premium community, and that you'll be chasing in at the 22s, 0.8s, 0.9s, and you'll have a stop up to 23. And some of you might see this later on today, and it could have gone down further. The more you pinch that risk reward, the earlier you are in. If you're in at 23s and you've got stops at 23.7s, you're getting closer to half a dollar, 0.4 of a dollar. This makes a massive difference in terms of risk rewards, how much money you can risk for the same amount of loss, etc. So this short call, my first entry is actually on that wick. Get that short call. Give me the short call. Thank you. My ongoing love affair with technical tools on TradingView. Let's get this down, 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 down. Were you to go to 18, which I would say if we trigger, which will be the break of the 22 mark, this would come out at a pretty decent risk-reward ratio, 33.8. When last did you land a 33.8? Well, you won't be landing it today. You'll be chasing in over here, and that's the difference, and that's what my premium community have the right to pay for. You'll be looking at 6 instead of 33. Did you just see the number, the mathematics differential of that earlier entry? Did you just see? You were at 33.8, virtually 34. And if you were to get in right at this moment at 16, same stop to the same target, in actual fact, that it slipped a little bit forward. If you were to go to 18, you'll be at a 5.27. By the way, if we go to the 13, and that's the head and shoulder target, which I do think has a decent, it does boost you back up to 12. What would it have been? What would it have been on the early? Let's get that risk reward that we're sitting on. The premium guys, we are roughly here. Now that's something to write home about. 30 plus. Excuse me. Anyway, let's have a look at the gold, because we said gold to go down as well. People won't like this, as I've stressed. This is a dispassionate trading call. It's not a bad on gold. As I've already highlighted, we're fans of precious metals. It's more about trading direction, and how the masses will probably get this incorrect. As they're already illustrating. Now, gold hasn't sold off as much, but we would expect it, 1854 to 1853, we'd expect it to let go of the 1800 handle in a sell-off and could indeed get to the 1500 mark. During that time, the gold-silver ratio will be going up, and silver is showing already a greater, higher relative weakness. Again, for those, and most people are still bulls, despite the trade today, the data of today, and understanding this technical analysis. We looked at this from the get-go and we said it's a downside break on balance of probabilities, in our opinion, and we continue to hold that view. This is an overperformance slide. You'll learn about that, our own technical analysis specifically for events like this that has been created to give you the best opportunity to maximize unique events like this. I'd expect this to trade down. I'd expect it to run the 1800 to the downside and to then break this basing ascending grind line. That's right, a special term that is part of our theory as well that you'd learn about if you're on our program and doing a call. themarketsniper.com, book a chat. Just because you have a chat doesn't mean you'll be given the opportunity to join us. We need to make sure that people are sane, own their own outcomes, and are ready to learn first and are not overly driven to immediately make money back. That is a very negative psychology setup, and it will create pattern behavior and oversizing and a lot of other things. So assuming you are going to take it on the low, move slow, and recognize that slow dough is the only dough, you will then potentially become a member if it works both for both parties. So 1553 could indeed be the downside target. So we've given you wheaten to the downside. We have given you silver and gold to the downside. That's our position. Gold is still quite early, but I do think that silver is going to be the one that falls. Let's show you that gold-silver ratio as well. XAU, XAG, and that is a little hammer, and that is the beginning of a move up. I tells you it's a beginning of a move up, a hammer and a beginning of a move up, and I would expect to see this level taken out and getting into the lower 80s on the upside for the gold-silver ratio. Long run, however, we are macro precious metal bulls, and we think that moment will come. I just think you sell off first. Okay, that is largely that. Was there anything else I wanted to show you? Gold-silver ratio, show you a bit bigger time frame, the gold-silver ratio, because we did call the top of the gold-silver ratio up top here on the sell-off and said get long precious metals, both gold and silver, at the 113 break. So we've been part and parcel of all of this. It's quite possible we creep a little bit back up before we get a further downside move. We highlighted also that the 70 gold-silver ratio has had numerous periods of support, a small dip below, and again a rally, and you could see a little bit of a rising wedge structure that could form, maybe a bit of upside for this before it eventually breaks to the downside in a bull market for both metals and silver to perform. Again, you will also probably find platinum to be in a little bit of trouble. You'll probably find the likes of palladium, but don't forget they have unique industrial uses. We've even highlighted palladium as a bit of a cranky head and shoulder. We'll show you that. Why not? Let's pull it in. Let's pull it into this coverage for you. This is a bit of a cranky possible head and shoulder. It's been a very entertaining market. It did do a huge amount. That's palladium. There you go. There's your potential head. That was a super big shoulder, by the way. And you've had another fairly decent shoulder, but potentially smaller. In the event rates start going up, that's right, rates start going up, the debt markets are going to hurt. They are going to hurt all asset valuations. That's going to hurt a lot of asset categories, and you will start to see the firming up of the dollar in a move back up in that event, if it is to happen. Let's show you that 10-year yield as well, just as a little bit of a runner. We've called for that to run through 2.16. It's only just, can I just point out, you have passed the 2% payment rate on the 10-year. You haven't been there since July. That was part and parcel of your bonds clip that you can watch on this YouTube channel, where we respond to the Society of Technical Analysts comments on our bond market coverage, and we give you an update and why that market's such a critical market. But today is about the precious metals. Our community is positioned short. They were in early. You are getting a possible 6 RRR. They may well be on a 30. This is not a recommendation. We do not give you advice. We are a learning channel, and I am sharing in essence that which I'm doing, and you can decide whether you should follow it too. By the way, you will note Bitcoin, for my crypto friends, and I'm just going to take that analysis off, is posting a little bit of a shooting star after making a high, yes, a high of around 45,899. You're at 45.9, virtually 46. You're now at 43. If you don't think you're going to get at least some form of a pullback over here, you're going to get a nasty surprise when those bond yields start going up. So beware what Bitcoin will do in dollar terms. We've suggested before, our first scenario is to position for defense. And we stand by that, and we think today was a pivotal day with that inflation data where a number of key markets will have turned. Again, themarketsniper.com. Get in touch and engage there. We appreciate likes and shares. I hope you're learning something from following our channel. You can also follow us on @thecryptosniper, which is both a YouTube and a Twitter handle, and of course this one @themarketsniper, which is both a Twitter and a YouTube. And our Reset Sniper content is hosted on The Market Sniper on Odyssey. In other words, YouTube does not like us and the things we have to say about those aspects surrounding the Great Reset. Until I speak to you again, we hope to see you, and I will say goodbye, and I hope you enjoyed.